Legal disclaimer: this video content is strictly for educational and entertainment purposes only. It does not constitute financial, investment, tax, or legal advice. The foreign exchange market, widely known as Forex, involves significant risk, including the potential loss of your entire investment. Trading on margin carries a high level of risk and may not be suitable for all investors. Leverage can work against you as well as for you. Before deciding to invest in foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. There is a possibility that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading, and seek advice from an independent financial advisor if you have any doubts. Past performance is not indicative of future results. All examples used in this masterclass are hypothetical and used for illustrative purposes to demonstrate market mechanics and platform functionality. By continuing to watch, you acknowledge that you are solely responsible for your own financial decisions and due diligence. Here is a statistic that the brokerage industry does not want you to dwell on, but one that you absolutely must brand into your memory before you ever click that buy button. It is widely referred to among professional circles as the 90-90-90 rule. It states that 90% of retail traders lose 90% of their capital within their first 90 days of trading. Let that sink in. The odds are statistically stacked against the uneducated participant in a way that is almost mathematically designed to drain your account. When you enter the Forex market, you are not stepping into a friendly local marketplace. You are stepping into an arena dominated by central banks, hedge funds, high-frequency trading algorithms, and institutional behemoths that move billions of dollars in fractions of a second. These entities have informational advantages, technological superiority, and capital depth that the average person cannot comprehend. They are the sharks, and the unprepared retail trader is simply chum in the water. However, there is a backdoor. There is a specific professional-grade method to neutralize this threat, to bypass the 90-day slaughter, and to gain the same experience as a Wall Street veteran without risking a single penny of your hard-earned savings. It is the only way to learn to fly the fighter jet without crashing it. This is the start of a comprehensive deep dive masterclass designed to solve the single biggest problem facing aspiring traders today: the gap between theoretical knowledge and practical execution. Most people lose money not because they lack intelligence, but because they lack a safe environment to fail. You are here because you want to tap into the largest financial market in the world, a market with a daily trading volume exceeding $6 trillion, but you are terrified of becoming another statistic. You want to understand how to read price action, how to manage risk, and how to navigate the volatility of global currencies, but you do not want to pay the market tuition that destroys so many financial futures. The solution is the strategic, disciplined, and serious use of a demo account. This is not a game. This is your flight simulator. Over the course of this extensive series, we are going to dismantle the myths of trading and rebuild your understanding from the ground up, using a simulation environment as our laboratory. We are not just going to show you how to open an account, we are going to teach you how to treat a demo account with the same psychological weight and rigorous discipline. Any as a live fund. The promise of this masterclass is simple. By the time you finish this series, you will have a complete, step-by-step protocol for executing your first trade, managing it, and closing it, all while operating within a risk-free environment that allows you to make the necessary mistakes now, so you do not have to pay for them later. The concept of the first trade is often romanticized in movies and online culture. You see a protagonist staring at 6 monitors, shouting orders, and making millions in seconds. The reality is boring, methodical, and highly technical. The reason we are dedicating an entire 10-part series to this process, starting with this deep dive, is because the mechanics of the Forex market are deceptively simple but operationally complex. Anyone can download an app and press buy on the euro to US dollar pair. A child could do it. But understanding why you are pressing buy, what your invalidation point is, how margin calls work, and how swap fees affect your bottom line is the difference between gambling and trading. Let us expand on the environment we are about to enter. The foreign exchange market is the backbone of international trade and investment. It is decentralized, meaning there is no central exchange like the New York Stock Exchange. Instead, it operates through a global network of banks, corporations, and individuals trading one currency for another. Because this market is open 24 hours a day, 5 days a week, the opportunities are endless, but so are the traps. In a live environment, emotional discipline is the first casualty. When real money is on the line, your heart rate increases, your decision-making capability diminishes, and the fight or flight response kicks in. This biological reaction is terrible for trading. It causes you to hold on to losing trades hoping they will turn around, and to cut winning trades early out of fear that the profit will evaporate. This is where the philosophy of the demo account becomes your greatest asset. Most beginners treat a demo account like a video game. They take massive, unrealistic trades because the money isn't real. If they blow up the account, they simply hit reset. This approach is a waste of time and actually instills bad habits that will bankrupt you in the real world. In this masterclass, we are going to force you to change your paradigm. We are going to treat the demo account as a forensic tool. We will set up the account with a realistic balance, not the $100,000 most brokers give you by default, but a sum that matches what you actually plan to invest, perhaps $1,000 or $5,000. This calibrates your psychology to see realistic percentage gains and losses. Furthermore, we need to address the technical landscape you will be navigating. The software used to trade Forex, typically platforms like MetaTrader 4, MetaTrader 5 or TradingView, is professional-grade software. It is filled with charts, indicators, order books, and news feeds. For a beginner, opening this software for the first time is like sitting in the cockpit of a Boeing 747. There are buttons everywhere, blinking lights, and rapidly changing numbers. If you attempt to learn this interface while real money is fluctuating in your balance, you will panic. You will click the wrong button. You will enter the wrong lot size. You might intend to risk $10 and accidentally risk $1,000 because you didn't understand the contract size or the leverage settings. These are called fat finger errors, and in the live market they are irreversible. The bank does not give refunds for typos. By utilizing a demo account as we guide you through this series, you attain what is known in the industry as mechanical fluency. This means that the act of executing a trade becomes muscle memory. You know exactly where the stop-loss field is. You know how to calculate the pip value instantly. You know how to execute a trailing stop. You achieve this fluency without the anxiety of financial ruin hovering over your shoulder. This masterclass is designed to separate the learning of the tool from the learning of the market. You cannot learn to analyze complex geopolitical economic data if you are still struggling to figure out how to change the color of your candlesticks. We are also going to explore the concept of market tuition. Every successful trader has paid it. It is the money lost in the early years while learning the ropes. Some traders pay tens of thousands of dollars in market tuition to the market gods. By strictly adhering to the demo account protocols we will outline, you are effectively getting a full scholarship. You are going to learn the same lessons: how it feels when a trade goes against you, how it feels to miss a move, but the cost will be $0. We will simulate the emotional pain by enforcing strict rules. If you break your trading plan in the demo, you must restart the series. We are gamifying discipline. This journey will take us through the anatomy of a currency pair, understanding the bid-ask spread, which is the cost of doing business, and the crucial concept of leverage. Leverage is the tool that allows retail traders to control large positions with small amounts of capital. For example, with 1:100 leverage, $1,000 can control $100,000 worth of currency. This sounds fantastic until you realize it also means a 1% move against you can wipe out your entire account. In a demo environment, we can safely experiment with different leverage settings to see exactly how dangerous and powerful this tool is. We can mathematically prove to you why risk management is the only holy grail in trading. As we prepare to move into the technical setup in the next part of this series, I want you to commit to one thing. Commit to patience. The market will be here tomorrow. It will be here next week. It will be here next year. There is absolutely no rush to deposit real funds. The fear of missing out, or FOMO, is the primary driver of that 90% failure rate we discussed at the beginning. People feel like they are missing the gold rush. But the reality is that the market is an infinite stream of opportunities. By taking the time to master the demo account first, you are building a foundation of stone rather than sand. You are preparing to be the 1% of traders who treat this as a business, not a casino. In the upcoming sections of this masterclass, we will physically walk through the download and installation of the platform, the selection of a reputable broker for your demo feed, and the customization of your workspace. We will strip away the noise and focus on the signal. But for now, your homework is mental. You must accept that the demo account is not a toy. It is the most powerful training ground you will ever have. It is the crucible where your strategy will be forged. Welcome to your first step towards professional trading literacy. Now that we have established the philosophy, we must immediately confront the architecture of your training environment. To simply download an app and hit Create Demo Account is insufficient. It is the equivalent of training for a deep-sea dive by sitting in a bathtub. The water is there, but the pressure, the darkness, and the disorientation are completely absent. If you set up your demo account incorrectly, you are not learning to trade. You are learning to play a video game that has no correlation to the brutal reality of the live markets. This distinction is where the 90% we discussed earlier seal their fate before they even place their first trade. Let us begin with the platform selection. In the world of Forex, there is a dichotomy between analysis and execution. For analysis, modern traders often flock to web-based platforms that offer sleek interfaces, cloud syncing, and social networking features. These platforms are visually intuitive, offering drag-and-drop tools that feel like modern software. However, the industry standard for execution, the actual placing of trades, remains a piece of software that looks like it was built in the late 90s on a Windows 95 operating system. This is MetaTrader 4 or MT4. You might ask, why would the largest financial market in the world rely on software that looks so antiquated? The answer is stability and universality. MT4 is the cockroach of the trading world. It survives everything. It requires very little processing power, meaning it can run on a dedicated server in a data center without crashing. It connects to almost every broker on the planet. When you are setting up your demo, you will likely be forced to choose between MT4, its successor MT5, or a proprietary broker platform. The professional recommendation is to learn MT4. Why? Because proprietary platforms are designed to keep you trapped with one specific broker. If you learn their unique interface and then need to switch brokers to get better spreads or lower commissions, you have to relearn an entire ecosystem. If you master MT4, you can move your skills to any broker in the world instantly. It is the universal language of retail Forex. Now we must address the infinite money glitch psychology. When you open a standard demo account, most brokers will default your starting balance to $100,000. They do this for a psychological reason. They want you to feel wealthy. They want you to see large profit numbers. If you open a trade on a $100,000 account and the market moves 1% in your favor, you see a profit of $1,000. Your brain releases dopamine. You feel successful. You feel ready. But let us apply a rigorous imagine-if scenario. Imagine you are a 25-year-old with $2,000 in savings that you intend to invest. You have spent 3 months practicing on a $100,000 demo account. You are used to seeing profits of $500, $800, or $2,000. You finally deposit your real $2,000. You place a responsible trade. The market moves that same 1%. You look at your screen. You have made $20. The disconnect creates a psychological shock. The $20 feels insignificant compared to the thousands you were making in the demo. Subconsciously, you determine that this is too slow. You calculate that at this rate, it will take you decades to buy a house. So what do? You over-leverage. You increase your risk size to try and replicate the dollar amounts you saw in the demo account, rather than the percentage returns. This is the exact moment you blow your account. Therefore, the rule for this masterclass is absolute. You must manually adjust your demo account balance to match exactly what you plan to deposit in real life. If you plan to start with $500, you must contact the broker's support or use the custom settings to set your demo balance to $500. You need to calibrate your brain to get excited about a $5 win. You need to feel the pain of a $10 loss. If you cannot respect the small numbers, the market will never trust you with the big ones. This brings us to the hidden danger of the perfect fill. In a demo environment, you are trading in a vacuum. When you click buy at a specific price, the server gives you that exact price instantly. This is because there is no counterparty. You are trading against a computer algorithm that accepts your order regardless of market conditions. In the live market, for every buyer, there must be a seller. During times of high volatility, like the release of the U.S. non-farm payroll data or an interest rate decision by the Federal Reserve, liquidity can dry up. Case studies of retail traders during the Swiss franc Black Swan event of 2015 illustrate this vividly. Traders who had stop-loss orders set at a specific price found that their orders were executed hundreds of pips away from where they intended. This is called slippage. In a demo account, slippage rarely happens. You might practice trading news events on a demo and think you have found a foolproof strategy to capture quick spikes. You see the profit locked in instantly. You think you have hacked the system. Then, you take that strategy to a live account with real liquidity constraints, and the slippage wipes you out instantly. The demo account can lie to you about liquidity. You must understand that the demo is a simulator of price movement, not necessarily a simulator of market liquidity. We must also discuss leverage, the double-edged sword that brokers are all too happy to hand you. Leverage is essentially a loan provided by the broker to allow you to control a larger position. If a broker offers 1:100 leverage, it means for every $1 you put up, you can control $100 of currency. High leverage is often marketed as a benefit, a way to maximize your potential. Let's look at the math of a disaster. Imagine you have a $1,000 account and you use 1:500 leverage to open a massive position. You are effectively controlling $500,000 of currency. A mere 0.2% move against you, a tiny fluctuation that can happen in seconds, would result in a loss equal to your entire $1,000 balance. In a demo account, you might shrug this off and hit reset. In the real world, that is your rent money gone in a heartbeat. For your setup, we are going to adhere to the strict risk management protocols used by professional proprietary trading firms. We will restrict our effective leverage. Even if the broker gives you 1:500, you will trade as if you only have 110 or 120. We will build the discipline to ignore the excessive borrowing power. The next critical component of your setup is the feed quality. Not all price feeds are created equal. Some unscrupulous brokers use what is known as a B-book model, where they take the other side of your trade. In their demo environments, they might smooth out the price action to make the charts look cleaner and easier to read than they actually are. They remove the noise and the erratic wicks that often stop traders out. This creates a false sense of security. When setting up your demo, it is advisable to seek out a broker that offers an ECN, electronic communication network, demo or a raw spread demo. These feeds mimic the interbank market more closely, showing you the variable spreads. You need to see the spread widen during the Asian session rollover, 5 p.m. Eastern Standard Time. You need to see how the bid and ask prices separate during news. If your demo feed always shows a fixed perfect spread, you are training in a sterile laboratory that does not exist in the wild. We are approaching the moment of truth where we will actually open the terminal. But before we look at the charts, you need to understand the time zone problem. The Forex market operates on a 24-hour cycle, but it is divided into 3 major sessions: the Asian session, Tokyo/Sydney, the London session, and the New York session. A strategy that works beautifully during the high-volume overlap of London and New York, 8 a.m. to 12 p.m. Eastern Standard Time, might be completely useless during the slow, ranging hours of the late Asian session. Many beginners make the mistake of testing their demo account whenever they have free time, perhaps late at night after work. They might find that the market is calm, ranging, and easy to predict. They develop a strategy based on this low volatility environment. Then, they take a day off work to trade the New York Open with real money, and they get crushed by the explosion of volatility. Your demo practice must mirror your intended live trading hours. If you plan to trade the New York Open, you must practice during the New York Open. You cannot train for a sprint by practicing walking. We have now defined the parameters of the arena. You have rejected the default $100,000 illusion. You have chosen a platform that prioritizes execution stability over visual flair. You are aware that the instant fills of the demo are a luxury, not a guarantee. You understand that leverage is a loan, not a gift. The stage is set. You have the software installed, the credentials generated, and the balance calibrated to your reality. But a blank chart is a terrifying thing. It is just a grid of empty space waiting for data. What happens when the first candlestick appears? How do we translate a squiggly line on a screen into a financial decision? How do we distinguish between a random fluctuation and a high probability setup? In the next part of this masterclass, we are going to turn the lights on. We are going to dissect the anatomy of the candlestick chart and reveal the specific visual language that the market uses to communicate with those who know how to listen. The code is about to be broken. The code you are looking at is not a random jumble of geometry. It is a sophisticated, centuries-old method of recording human psychology, fear, greed, and mass behavior. When you open your demo platform, likely MetaTrader or TradingView, your default view might be a line chart, a simple jagged line moving across the screen. Your first action must be to destroy that view. The line chart is a liar. It connects only the closing prices, effectively erasing the chaos, the panic, and the volatility that happened between the opening and the closing bell. To trade without seeing the full range of price movement is like trying to navigate a ship by only looking at the calm surface of the water, completely ignoring the jagged reefs just beneath the waves. You must switch your view to Japanese candlesticks. The history here is vital for your mindset. This system was not invented by Wall Street bankers in the 1980s. It was developed in the 18th century by a Japanese rice trader named Munehisa Homa. He realized that while the price of rice was technically determined by supply and demand, it was heavily influenced by the emotions of traders. He created a visual system to track these emotions. When you look at a candlestick on your demo account, you are looking at a battlefield report. Let us perform a deep autopsy of a single candle. This is non-negotiable knowledge. Every candle tells a story of 4 specific price points: the open, the high, the low, and the close. Together, they form the acronym OHLC. Imagine a standard green or bullish candle on a 1-hour time frame. This candle represents 60 minutes of war. At minute 0, the price opens at a specific level. This is the bottom of the candle's body. Let's say, hypothetically, the euro is trading against the dollar at 1.1000. The moment the hour begins, sellers might take control. They push the price down to 1.0990. On your screen you would see a red line dropping. But then buyers step in. They see value at 1.0990 and aggressively buy, pushing the price back up past the open all the way up to 1.1050. This creates a long line extending downward from the body. This is called the wick, or the shadow. That lower wick is critical. It is forensic evidence. Tells you that sellers tried to push the price down and they failed. It represents rejection. The longer the wick, the stronger the rejection. Back to our story. The bulls push the price up to a high of 1.1050. But as the hour comes to an end, some traders take profit. The price dips slightly and closes at 1.1040. The colored block in the middle, the distance between the open 1.1000 and the close 1.1040, is the body. The thin line above the body is the upper wick. Why does this matter for your first trade? Because beginners chase the movement of the current price, while professionals analyze the shape of the closed candle. If you see a candle with a tiny body and massive wicks on both sides, the market is screaming indecision. This is often called a doji. It means the bulls and bears fought to a draw. If you enter a trade during a doji on your demo account, you are essentially gambling because the market has not picked a winner yet. Conversely, if you see a candle with a massive green body and almost no wicks, it indicates strong conviction. The buyers were in control from the open to the close. Now we must complicate the picture with the concept of time frames. This is where new traders often experience analysis paralysis. Your demo platform allows you to view charts in various increments: 1 minute, 5 minute, 15 minute, 1 hour, 4 hour, daily, weekly, and monthly. This is known as fractal geometry. The patterns you see on a 1-minute chart are mathematically similar to the patterns on a monthly chart, but their significance is vastly different. Think of it like Google Earth. The monthly chart is the view from a satellite. You can see the entire continent, the major mountain ranges, and the direction of the massive rivers, the long-term trends. You cannot see the cars on the street. The 1-minute chart is the view from a street camera. You can see every pothole, every pedestrian, and every minor accident. Here is the trap. New traders are addicted to the 1-minute and 5-minute charts. They want action. They want to see the candles moving fast. They see a massive drop on the 5-minute chart and panic sell, thinking the market is crashing. But if they zoomed out to the 4-hour chart, they would see that this crash is just a tiny, insignificant pullback in a massive uptrend. They are getting shaken out by noise. For the purpose of this masterclass and your demo training, we are going to enforce a strict, top-down analysis rule. You are never allowed to execute a trade on a time frame unless you have consulted the time frame above it. If you want to trade on the 1-hour chart, you must first check the 4-hour or daily chart to see the bigger picture. If the daily chart is bullish going up, you should be very careful about selling on the 1-hour chart, even if the 1-hour candle looks bearish. You would be stepping in front of a freight train to pick up a penny. Let's look at a case study of a hammer candle, one of the most reliable signals in technical analysis, to see how a pro reads it versus a novice. Imagine the price has been falling for 3 days. It's a sea of red candles. Then a candle forms that pushes a new low, looks like it's going to continue the crash, but suddenly snaps back and closes near its high, leaving a long lower wick and a small body at the top. Looks like a hammer. The novice looks at this and thinks, the price is still low, the trend is down, I should keep selling. The professional looks at the exact same data and reads the narrative. The sellers exhausted their ammunition. They tried to break the floor and were overwhelmed by a wall of buy orders. The momentum has shifted. On your demo account, this is where you learn to pause. You spot the hammer. You don't buy instantly, remember, no guarantees, but you prepare. You wait for the next candle to confirm that the hammer wasn't a fluke. Another critical visual element you will see on your demo chart is the bid and ask line. Usually the chart draws the bid price, the price you can sell at. However, when you buy, you pay the ask price, which is slightly higher. This difference is the spread, which we touched on earlier. In the visual settings of your platform, F8 on MetaTrader, you must enable Show Ask Line. Why? Imagine you are in a sell trade. You have your stop loss set at 1.0500. You see the price wick up to 1.0498 and then drop. You think you are safe. But suddenly your trade is closed and you have lost money. You scream at the broker. The price never hit my line. But it did. The ask line hit your stop loss, even though the bid line, the one drawn on the chart, didn't. By visualizing both lines, you see the true cost of the trade. You see the spread widening and narrowing in real time. This is the kind of technical nuance that separates a demo gamer from a future professional. We are also going to strip your chart of visual clutter. Default demo layouts often come with grids, period separators, and perhaps a jarring background color. These are distractions. We want a clean workplace. Set your background to a neutral gray or soft white/black to reduce eye strain. Turn off the grid. Make your bull candles green or white, and your bear candles red or black. You need to be able to glance at the screen and instantly recognize the balance of power without squinting at grid lines. You are now looking at the raw data of the market. You understand that a candle is not just a bar. It is a struggle between two opposing forces. You understand that a 1-minute candle is just a pixel in the painting of the daily chart. You can identify the wicks as scars of failed price attempts. But knowing how to read a single candle, or even a group of candles, is not enough. A hammer candle means nothing if it appears in the middle of nowhere. Context is king. To place a valid trade, we need to know where these candles are forming. Are they hitting a glass ceiling? Are they bouncing off a concrete floor? This leads us to the architectural structure of the market. We have the bricks, the candles, but now we need to see the building. In the next part, we are going to draw the invisible lines that banks and hedge funds defend with billions of dollars. We are going to map out support and resistance. If you could strip away the flashing lights, the news tickers, and the complex indicators, and look at the naked skeleton of the market, you would see a structure built entirely on memory. The market is not a random walk. It is a collective memory of pain and profit. Support and resistance are the visual representations of these memories. They are the invisible floors and ceilings that confine price action, and understanding them is the difference between blindly guessing a number and strategically identifying a value area. When banks and institutions trade, they do not enter orders at random decimals. They wait for price to reach specific, historical levels where they know liquidity exists. In this part of the masterclass, we are going to mark up your demo charts with the same levels these institutions are watching. Let's define the terms. Support is a price level where a falling currency pair has historically stopped and reversed. Think of it as a floor. It represents a price point where demand, buyers, is strong enough to overcome supply, sellers. Resistance is the opposite. It is a ceiling. It is a level where a rising price hits a wall and falls back down, representing a point where supply overwhelms demand. But here is the critical nuance that most tutorials miss, and why most beginners fail. Support and resistance are not lines. They are zones. Imagine if you drew a thin line on your chart at 1.0500 and said, "This is support." You are expecting the market, a chaotic beast of millions of participants, to respect that single pixel with surgical precision. It rarely happens. Instead, you must treat these levels as if you are drawing them with a thick crayon, not a fine point pen. Consider a case study involving the big figures or psychological levels. Human beings are cognitive misers. We prefer round numbers. We don't like to buy at 1.04937. We like to buy at 1.0500. Banks and large hedge funds operate similarly, but for liquidity reasons. If a massive institution needs to offload 500 million euros, they cannot just hit sell at any random moment without crashing the price against themselves. They place limit orders at round numbers, creating a massive wall of sell orders. On your demo chart, I want you to look for these round numbers, prices ending in 00 or 50. You will often see the price approach these levels, pierce them slightly, and then violently reject them. If you had a thin line drawn, you might have been faked out or stopped out. But if you drew a zone of 10 to 20 pips around that number, you would see that the price was simply testing the liquidity within that area. This is the first exercise for your demo account. Identify the zones, not the lines. Now we must discuss the phenomenon of polymorphism in market structure, where the floor becomes the ceiling. This is one of the most reliable behaviors in financial markets. Imagine a multi-story building. You are standing on the floor of the second story. That floor is your support. If you take a sledgehammer and smash through that floor, you fall to the first story. Now, if you look up, the floor you just stood on has become your ceiling. It is now resistance. In trading terms, when a major support level is broken, it typically acts as resistance when the price returns to it. This provides a specific, actionable setup for your demo practice called the breakout and retest. Novice traders see a support level break and immediately chase the price down, selling at the bottom. This is dangerous because the price often snaps back like a rubber band to test the level it just broke. The professional waits. They wait for the price to return to the broken floor, see it act as a ceiling resistance, and then they enter the sell trade. This confirms that the market structure has actually changed. Let's walk through the top-down mapping process you should perform every Sunday before the market opens. Start on the monthly chart of your demo platform. You are looking for the major, obvious turning points, prices where the market reversed dramatically. Draw horizontal zones at these levels. These are your macro levels. They are like concrete walls. It takes a massive amount of economic energy to break them. Next, drop down to the weekly chart. Use a different color for these zones. These are slightly less strong but still significant. Finally, go to the daily chart. These are the levels that will be relevant for your trading week. Do not go lower than the 4-hour chart for drawing your major structure. If you start drawing support and resistance on a 5-minute chart, you will end up with a spaghetti chart, lines everywhere, giving you contradictory signals and analysis paralysis. The golden rule is, if you have to squint to see it, it's not there. The best levels scream at you. We must also address the imagine if scenario of the liquidity trap, often called a stop hunt. Imagine you are a bank trader. You can see where all the retail traders have placed their stop-loss orders. Most textbooks teach retail traders to place their stop-loss just below support. So, there is a massive pool of pending sell orders sitting just below that 1.0500 level we discussed. If the bank wants to buy a massive amount of currency, they need a massive amount of sellers to buy from. Where can they find them? Right below support. So they might push the price down to 1.0490, triggering all the retail stop losses, which become market sell orders. The bank buys up all that cheap liquidity, and then the price rockets back up to 1.0600. The retail trader looks at their screen, sees they were stopped out at the absolute bottom, and cries rigged. It isn't rigged, it is mechanical. By understanding zones and waiting for confirmation on your demo, you learn to avoid being part of the liquidity meal. Case studies suggest that patience at these levels is the highest revenue-generating activity a trader can engage in. It is not about clicking buttons, it is about waiting for the price to come to you. Treat your charts like a sniper, not a machine gunner. You set your trap at a high probability resistance zone and you wait. If the price turns around before hitting your zone, you do nothing. You missed the trade. That is fine. Capital preservation is more important than profit generation. In your demo account, practice the art of doing nothing. Sit on your hands until the price touches your zone. As you mark these levels on your chart, you will begin to notice a rhythm. Price pings between these levels like a ball in a pinball machine. It moves from a monthly support to a weekly resistance, consolidates, breaks out, and moves to the next level. This is the market structure. It gives you a roadmap. Instead of staring at the void, you now have landmarks. You know that if price breaks level A, it is highly likely to travel to level B. This allows you to set realistic take-profit targets. However, a static horizontal line only tells half the story. The market is dynamic. It moves in waves. Sometimes the floor isn't flat. It's slanted. The market can be trending upwards, making higher floors, or trending downwards, creating lower ceilings. Knowing where the walls are is useless if you don't know which direction the crowd is running. You might identify a strong resistance level, but if the market is in a raging bullish trend, that resistance wall is going to get smashed like glass. We have built the foundation. You have your account, your candles, and your map of the key levels. But now we need to identify the wind direction. We need to understand the flow. Is the tide coming in or going out? In the next part, we will introduce the concept of trend identification and how to draw the dynamic, diagonal lines that allow you to surf the market rather than drown in it. We are going to learn why the trend is your friend until it bends. There is a saying on Wall Street that has survived for over a century because it is mathematically irrefutable. The trend is your friend. It sounds like a cliche, but in the context of your demo trading journey, it is a survival mechanism. If support and resistance are the map of the terrain, the trend is the current of the river. You can be the strongest swimmer in the world. You can have the best risk management and the sharpest eyes. But if you try to swim upstream against a raging Class 5 rapid, you will drown. The market is that river. It flows with the collective capital of the entire global economy. Your job is not to stop the river. Your job is to jump in a raft and let the current carry you to profit. Let us dissect the anatomy of a trend. On your demo chart, a trend is not simply a price moving up or down. It is a specific structural sequence. An uptrend is defined strictly by a series of higher highs and higher lows. Think of it like a staircase. The price pushes up to a new peak high, pulls back slightly to rest but stays above the previous low, higher low, and then launches again to break the previous peak, higher high. As long as this staircase structure remains intact, the trend is bullish. The bulls are in control. Every pullback is an opportunity for them to reload their ammunition at a better price. Conversely, a downtrend is a series of lower lows and lower highs. The price drops, bounces up a bit but fails to reach the previous height, and then crashes down to a new depth. This is the elevator going down. The bears are slamming the price, and the bulls are too weak to push it back up. This sounds elementary, yet millions of traders lose their accounts because they refuse to accept the visual evidence right in front of them. They suffer from top calling syndrome. Imagine if you are watching a rocket launch. The rocket is accelerating upward at thousands of miles per hour. It is clearly in an uptrend. The top caller is the person who looks at the rocket and says, "That's too high. Can't possibly go higher. I'm going to bet my life savings that it crashes right now." The rocket continues to soar, and the top caller is incinerated. In the Forex market, this happens every single day. Traders see the euro to US dollar skyrocket and think, "It's overbought. It has to come down." So they sell, and the price rips higher, triggering their margin call. On your demo account, you must train your brain to stop asking, "How high can it go?" and start asking, "Is the structure still valid?" To visualize this structure, we use trend lines. These are the diagonal dynamic versions of the support and resistance zones we drew in the previous section. When you open your drawing tools in MetaTrader or TradingView, you will see a diagonal line tool. Here is the strict rule for drawing a valid trend line. You need at least 2 points to draw a hypothetical line, but you need 3 points to confirm it as a trend. Connect the higher lows in an uptrend with your line. Extend it out into the future. The ray feature in most software is excellent for this. This line acts as a diagonal floor. As price travels forward in time, it will often drift back down to touch this line, bounce off it, and continue upward. This touch of the trend line is a high probability entry signal. Why? Because algorithms and institutional orders are often stacked along this diagonal trajectory. When you are practicing on your demo, you are not just drawing lines. You are identifying the value area, where the trend is likely to resume. However, we must address the angle of attack. Not all trends are created equal. A trend that moves at a 45-degree angle is healthy and sustainable. It indicates a steady balance of buying pressure and profit-taking. But a trend that shoots up at an 80-degree angle, a parabolic move, is unstable. It is a sign of euphoria or panic. Like Icarus flying too close to the sun, these trends tend to collapse violently. In your demo trading, be wary of the vertical line. It usually signals that the move is nearing exhaustion, not that it is just beginning. Let's expand this into a trend channel. Often, the market moves in a perfect corridor. If you clone your upward trend line, the floor, and place the copy on the highs of the price action, the ceiling, you create a channel. The price pings back and forth within these diagonal walls. This is a trader's paradise. You buy at the bottom of the channel and take profit at the top. You are effectively surfing the wave. Case studies of the counter-trend trap reveal why you must practice this on a demo first. Novice traders love to catch falling knives. They see a price collapsing and think, "It's so cheap." They buy. The price drops another 50 pips. They buy more to average down. The price drops another 100 pips. This is how you blow an account in a single afternoon. There is a brutal maxim in trading. The market can remain irrational longer than you can remain solvent. Until the market proves to you, by breaking the sequence of lower highs, that the downtrend is over, you must assume the floor is made of quicksand. There is a sophisticated nuance here regarding fractal trends. This is where your timeframes clash. You might look at the daily chart and see a clear uptrend, but then you zoom into the 15-minute chart and see a violent downtrend. Who is right? Both are right, but the daily chart carries the heavy artillery. The 15-minute downtrend is likely just a pullback, or a correction, within the larger daily uptrend. If you try to sell based on the 15-minute chart, you are picking up pennies in front of a steamroller. The daily trend is the steamroller. On your demo account, practice aligning your trades. Wait for the 15-minute trend to align with the daily trend. When the small gear and the big gear turn in the same direction, that is when you get explosive momentum. This is called multi-time frame alignment, and it increases the probability of your trade success exponentially. We must also discuss what happens when the trend breaks. Nothing lasts forever. Eventually, the buyers run out of money or the news changes and the trend line is breached. This is the breakout. But remember the lesson from support and resistance. Breakouts are often traps. A price might spike through your trend line, scaring everyone out, and then close back inside the trend. This is a fake out. To avoid the fake out, apply the break and retest rule to trend lines as well. If an uptrend line is broken, do not sell immediately. Wait for the price to come back up and kiss the underside of the broken trend line. If it rejects that line, turning the old support into new resistance, that is your confirmation that the trend has reversed. By now, your demo chart should look like a battle plan. You have your horizontal zones marking the historic battlefields. You have your diagonal trend lines marking the direction of the invading army. You know where the price is likely to stop, support, and which way it is trying to go, trend. You are no longer looking at random noise. You are reading a narrative, but there is still a missing piece of the puzzle. We know the where, support/resistance, and the direction, trend. But we do not know the when. Timing is everything. You can have the right idea but the wrong timing and still lose money. How do we gauge the momentum? How do we know if the car is running out of gas before it hits the wall? How do we measure the invisible strength of the market? To do this, we need to open the toolbox of indicators. These are mathematical formulas that crunch the price data and give us visual signals. But be warned, most traders use them incorrectly. In the next part, we are going to debunk the myths of trading indicators and show you the only 2 or 3 tools you actually need to time your entry with sniper-like precision. We are going to separate the signal from the noise. If you walk into the control room of a nuclear power plant, you expect to see thousands of dials, gauges, and flashing lights. It looks impressive. It looks complex. It looks professional. Naturally, when a new trader opens their demo account for the first time, they try to replicate this aesthetic. They pile on the Bollinger Bands, the stochastic oscillator, the MACD, the parabolic SAR, and the Ichimoku cloud until the actual price candles are barely visible behind a web of neon lines. This is known in the industry as the Christmas tree effect, and it is one of the fastest ways to paralyze your decision-making process. In this section of the masterclass, we are going to perform a radical cleanup. You must understand a fundamental truth about trading indicators. They are all derivatives of price. They do not predict the future. They merely report the past. They are the speedometer of your car, telling you how fast you were going a second ago. They are not the windshield. If you drive by looking only at the speedometer and never at the road, you will crash. However, when used correctly as a confirmation tool rather than a decision maker, they can tell you when the engine is overheating or when the tank is empty. For your demo account foundation, we are going to install just 2, maybe 3 specific tools that provide actual tactical value. First, let us install the moving average. Specifically, we are going to use the exponential moving average, or EMA. Open your indicator list and select moving average, then change the method to exponential. Why exponential? Because unlike a simple average, the EMA gives more weight to recent price action. It reacts faster. It is more relevant to the now. We will set up 2 specific EMAs, the 50 period and the 200 period. These are the industry standards used by major institutions. The 200 EMA acts as the long-term value. When the price is above the 200 EMA, the market is in a long-term uptrend. When it is below, it is in a downtrend. This is your do not cross line. If the price is below the 200 EMA, You are forbidden from buying on your demo account. You only look for sell setups. This simple filter alone eliminates half of the bad trades beginners make. Now consider the 50 EMA. In a healthy trend, price will often pull back to the 50 EMA and bounce off it like a tennis ball hitting a pavement. This is called dynamic support. Remember those horizontal support zones we drew in part 4? Imagine if a horizontal support zone intersects exactly with the 50 EMA line. That is a confluence. It means you have two independent reasons to believe the price will hold. On your demo, watch how price respects these lines. It is not magic. It is a self-fulfilling prophecy because millions of algorithms are programmed to buy at that exact average. The second tool we will add is the Relative Strength Index, or RSI. This is a momentum oscillator. It measures the speed and change of price movements. It runs on a scale of 0 to 100. The traditional textbooks, the ones written 30 years ago, will tell you that if the RSI is above 70, the market is overbought and you should sell. If it is below 30, it is oversold and you should buy. This advice is dangerous. In a strong viral trend, the RSI can stay overbought for weeks. If you sold every time the RSI hit 70 during a massive dollar rally, you would be bankrupt. We are not going to use the RSI for overbought/oversold signals. We are going to use it for divergence. This is the secret weapon of the professional technician. Imagine the price of a currency pair is a car driving up a hill. The RSI is the RPM of the engine. As the car climbs higher, price makes a higher high. You expect the engine to work harder, RSI makes a higher high. But what if the car reaches a new peak, but the engine RPM drops? That is divergence. The price is rising but the momentum is dying. It indicates that the buyers are exhausted. They are pushing the price up on fumes. When you see this on your demo chart, price making a higher high, but RSI making a lower high, it is a screaming signal that a reversal is imminent. Let's apply this to an imagine if scenario to solidify the concept. Imagine you are watching the pound sterling to US dollar pair. It has been rallying for 3 days. It hits a major resistance level from part 4. It forms a bearish candlestick pattern from part 3. Now you look at your RSI. You see the price is higher than it was yesterday, but the RSI line is lower. You have 3 pieces of evidence: structural resistance, price action rejection, and momentum divergence. This is a great setup. This is when you execute. You are not guessing. You are assembling a legal case against the currency pair. The third and final tool, which we will use not for entry but for context, is the ATR, or average true range. This indicator does not tell you direction. It tells you volatility. It tells you the average number of pips a candle moves in a given time frame. Why is this vital? Because it answers the question, how far away should my stop loss be? If the ATR says the average hourly move is 20 pips, and you place a stop loss 5 pips away, you are being foolish. Normal market noise will trigger your stop loss before the trade even has a chance to work. You are suffocating the trade. By checking the ATR on your demo, you learn to give the trade room to breathe, based on the current market reality, not your feelings. If the market is volatile, high ATR, you need a wider stop. If it is calm, low ATR, you can tighten it. Let's synthesize this into a routine. You open your demo platform. You check the 200 EMA to determine the trend direction, e.g., price is below, so we are bearish. You wait for a pullback to the 50 EMA, dynamic resistance. You look left and see a horizontal resistance level aligns with the 50 EMA, confluence. You check the RSI and see divergence, momentum failure. You check the ATR to calculate a safe stop loss distance. This process takes less than 30 seconds once you are fluent. But notice what we have done. We have moved from, I think the euro looks weak, to the euro is exhibiting structural, dynamic, and momentum-based failure at a key liquidity level. The difference in mindset is astronomical. However, there is a trap here that leads to analysis paralysis. You might find a trade where the price action is perfect but the RSI isn't diverging. Or the EMA is good but the horizontal support is a bit far away. You will freeze. You will wait for the perfect alignment of the stars. Case studies suggest that perfect trades are rare unicorns. Trading is about probability, not certainty. We are looking for a cluster of evidence. If you have 3 out of 4 signals, that might be enough to take the shot on your demo. The demo account is where you learn your own tolerance. You learn which signals you trust most. We have stripped the chart down to the essentials. We have the map, support/resistance, the weather report, trend/EMA, and the engine gauge RSI. We have a complete visual system for identifying a trade entry. You are standing on the edge of the cliff, ready to jump. You know the setup is good. You are ready to click sell. But wait, there is a mathematical formula that you have not solved yet. It is the formula that determines whether this trade will make you rich or leave you homeless. You might have the best entry in the world, but if you bet too much, a standard pullback will wipe you out. If you bet too little, you are wasting your time. How do you calculate the exact lot size to risk exactly 1% of your account? Most traders guess. Professionals use a calculator. In the next part, we are going to dive into the unsexy, but life-saving world of risk management and position sizing. We are going to teach you the math that protects your capital like a suit of armor. Because in this game, it's not about how much you make when you're right. It's about how little you lose when you're wrong. The shield is more important than the sword. Listen closely, because this is the single most boring and yet the single most critical chapter of your trading career. If you turn off the video now, you might as well take your money and set it on fire, because the result will be the same, only faster. We are entering the domain of risk management, specifically the mathematics of survival. Most aspiring traders obsess over the entry strategy, the sniper shot. They spend years perfecting the timing. But professional traders obsess over the exit and the size. They know that you can have a terrible strategy, flip a coin for every trade, and with superior risk management you might still break even. Conversely, you can have a 90% win rate, but without risk management, a single bad trade will bankrupt you. Let's start with the iron law of the 1%. This is not a suggestion. It is a mandate for your demo account practice. You must never, under any circumstances, risk more than 1 to 2% of your total account balance on a single trade. This sounds painfully slow to the newcomer, who wants to turn $500 into a Lamborghini. But let's look at the drawdown matrix, a piece of mathematical reality that destroys dreams daily. If you risk 10% per trade, which many aggressive beginners do, and you lose 5 trades in a row, you have lost roughly 40% of your capital. Now, here is the kick in the teeth. To get back to break-even, you do not need to make 40%. You need to make nearly 67%. As your capital shrinks, the percentage gain required to recover grows exponentially. If you lose 50% of your account, you need a 100% gain just to get back to where you started. That is a mathematical mountain that very few climbers ever conquer. However, if you risk 1% per trade and lose 5 trades in a row, you are down 5%. To recover, you need a gain of roughly 5.3%. That is a walk in the park. By risking small, you keep the hole shallow so you can always climb out. Now, we have to translate this percentage into the language of the platform, lots. When you open the order window on your demo, you will see a box labeled volume or lots. This is not the amount of money you are investing. It is the amount of currency units you are controlling. This is where the confusion leads to catastrophe. A standard lot, 1.00, represents 100,000 units of currency. On a pair like euro to US dollar, one standard lot means every single pip, the smallest price movement, is worth $10. If the price moves 10 pips against you, you lose $100. A mini lot, 0.10, represents 10,000 units. Each pip is worth $1. A micro lot, 0.01, represents 1,000 units. Each pip is worth 10 cents. Here is the imagine if scenario that plays out in demo accounts globally every day. Imagine trader A opens a demo account with $1,000. He sees a perfect setup. He gets excited. He leaves the default volume at 1.00 because he doesn't understand it. He clicks buy. The market moves just 20 pips against him. A normal breathing movement for the market. 20 pips times $10 per pip equals $200. In 5 minutes, he has lost 20% of his account. He is devastated. He tries to win it back, doubles the lot size to 2.00, and the next small move wipes him out completely. So, how do you determine the correct size? You must use the position sizing formula. You do not determine your lot size based on how much money you want to make. You determine it based on where your stop loss is. This is a crucial distinction. Step 1. Determine your risk amount. If you have a $5,000 demo account, 1% is $50. That is your hard limit. You are willing to pay $50 to see if this trade works. Step 2. Measure the distance to your stop loss. Let's say you analyze the chart, found a support level, and determined that your stop loss needs to be 25 pips away to be safe from noise. Step 3. The math. You divide your risk amount $50 by the stop-loss distance, 25 pips. The result is $2 per pip. Step 4. Convert to lots. Since a mini lot 0.10 is $1 per pip, you need 2 mini lots. So you enter 0.20 into the volume box. This calculation must happen before every single trade. If your stop loss needs to be wide, say 50 pips, because the market is volatile, your lot size must shrink to 0.10 to keep the risk at $50. If your stop loss is tight, say 10 pips, your lot size can increase to 0.50. This is called dynamic position sizing. It ensures that whether you lose a trade with a huge stop or a tiny stop, you lose the exact same amount of money. You are neutralizing the volatility. Let's deepen this with the concept of R multiples, or the risk-to-reward ratio. This is the only way to beat the house edge. In a casino, the house always wins because the odds are mathematically tilted in their favor. In trading, you can tilt the odds by ensuring your winners are larger than your losers. Case studies of successful proprietary traders show that many of them have win rates as low as 40%. They lose more often than they win. How are they millionaires? Because they religiously adhere to a minimum 1-to-2 or 1-to-3 risk-to-reward ratio. Imagine you take 10 trades. You lose 6 of them. You win only 4. You are a loser by standard definitions. But let's do the math with a 1-to-3 ratio. On the 6 losses, you lost 1 R each. That is a total loss of 6 R. On the 4 wins, you made 3 R each. That is a total gain of 12 R. 12 R minus 6 R equals a net profit of 6 R. You lost the majority of your trades, yet you made a massive profit. This is the magic of asymmetry. On your demo account, you must refuse to take any trade where the potential profit, the distance to the next resistance level, is not at least twice the distance to your stop loss. If the risk is $50, the target must be at least $100. If the chart doesn't offer that room, you do not take the trade. You let it go. Now we must address the equity stop fallacy. This is a bad habit where a trader decides, I only want to lose $50, so they place their stop loss exactly $50 away from their entry, regardless of what the chart looks like. The market does not care about your $50. It does not care about your wallet. If you place your stop at an arbitrary number, you are likely placing it right in the middle of no man's land, where market noise will trigger it before moving in your direction. Your stop loss must be placed at a technical invalidation point. This means you place it behind a support wall or above a resistance ceiling, a place where, if the price reaches it, your trade idea is proven wrong. Once you find that technical spot on the chart, then you use the math we discussed to adjust your lot size. The chart dictates the stop. The calculator dictates the lot size. Never the other way around. Practicing this on a demo account is psychologically difficult because the money isn't real. It is easy to be disciplined when the chips are plastic. You will feel the temptation to just eyeball it and throw on a 1.00 lot because you want to see big numbers. You must fight this. You are building muscle memory. If you get sloppy with the math in the demo, you will be sloppy in the live market, and the market will extract its tuition fee from your savings account. Consider the gambler's fallacy that plagues new traders. After 3 losses in a row, the novice thinks, I'm due for a win. They increase their risk to try and make back the previous losses in one shot. This is called revenge trading. It is the most common cause of account death. By strictly adhering to the 1% rule, you remove the emotion. A loss is just a business expense. It's the cost of inventory. You don't get angry when you buy apples for your grocery store. You don't get angry when you pay a stop loss. It is simply the entry fee for the game of probabilities. We have now constructed a fortress. We have the technical analysis to find the trade. We have the indicators to confirm the timing. And we have the risk management math to ensure that even if we are wrong, we live to fight another day. You are safer now than 99% of the people who download a trading app today. But we still have to perform the physical act. We have to interact with the machine. There are different ways to enter the market. You can jump in at the current price, or you can set a trap for the price to come to you. You can tell the computer to close the trade automatically at a profit, or you can trail the price to catch a massive trend. The buttons you click matter. A limit order is not the same as a stop order, and confusing them can lead to entering a trade in the wrong direction, or at a terrible price. In the next part of this masterclass, we are going to open the order window and dissect every single field. We are going to explain the difference between market execution and pending orders, and I will show you how to set up the set and forget system that allows you to trade without staring at the screen for 12 hours a day. We are moving from analysis to execution. The trigger is about to be pulled. We have arrived at the moment of kinetic action. Up until now, everything has been theoretical. You have drawn your maps, checked your weather reports, and calculated your fuel load. Now you are going to sit in the pilot seat and fly the plane. When you press F9 on your keyboard or click New Order in your terminal, a window pops up. To the untrained eye, this window is just a form to fill out. To the professional, this is the interface where money is transferred from the impatient to the patient. The first decision you face is the type of order. The default setting is Market Execution. This is the instant gratification button. If you click Buy or Sell now, you are telling the broker, get me in at whatever price is available right this millisecond. In a demo account, this usually works seamlessly. You get the price you see on the screen. However, this instills a dangerous habit. In the live market, market execution is subject to the whims of liquidity. If you try to market execute during a high-impact news event, you might click buy at 1.0500 and get filled at 1.0520. That 20 pip difference is called slippage, and it immediately puts you in a hole. Therefore, for your first proper demo trade, and for the vast majority of your professional career, we are going to ignore market execution. We are going to change the type to pending order. This is the weapon of the sniper. A sniper does not run into the battlefield shooting wildly. They set up their position, wait for the target to walk into the crosshairs, and then and only then do they engage. When you select pending order, you are presented with 4 distinct choices that confuse almost every beginner. Buy limit, sell limit, buy stop, and sell stop. You must memorize these distinctions as if your financial life depends on them, because it does. Let's focus on the limit orders first. A buy limit is used when you want to buy at a price lower than the current market price. Imagine the euro to US dollar is trading at 1.0600. You have identified a strong support zone at 1.0550. You do not want to buy now, it is too expensive. You want a discount. You set a buy limit at 1.0550. If the price drops down to hit your number, the broker automatically opens a buy trade for you. If the price never drops that far and flies away, you miss the trade. And that is fine. Professional traders would rather miss a trade than chase a bad price. Conversely, a sell limit is used when you want to sell at a price higher than the current market price. You are waiting for a rally into resistance so you can short the market at the best possible value. Limit orders are for fading the move, betting that the price will bounce or reject a level. Now consider the stop orders. These are momentum plays. A buy stop is placed above the current price. Why would you want to buy at a higher price? Because you are betting on a breakout. Imagine there is a concrete ceiling of resistance at 1.0650. You believe that if the price smashes through that ceiling, it will rocket to 1.0700. So you place a buy stop at 1.0655. You are telling the broker, do not put me in unless the market proves it has the strength to break this wall. For your first trade, we are going to execute a buy limit. This encourages patience. We are going to practice the art of letting the market come to us. Enter your price coordinate. Let's say our analysis from part 4 showed a support zone at 1.1200. Enter 1.1200 into the price field. Next, and this is non-negotiable, you must enter your stop loss SL and take profit TP before you place the order. Many reckless traders place the order first and figure out the stop loss later. In the seconds it takes to modify the order, a news spike could wipe out their account. You never enter a burning building without knowing where the exit is. In the stop loss field, enter the price level we calculated in the previous section using the ATR and technical structure. Let's say 1.1150. In the take profit field, enter your target based on the next resistance level. Let's say 1.1300. Notice the ratio. You are risking 50 pips, 1.1200 entry minus 1.1150 stop. To make 100 pips, 1.1300 target minus 1.1200 entry. This is a 1-to-2 risk to reward ratio. The math is sound. Now look at the expiration field. This is a pro tip often overlooked. If you analyze the market for a day trade, that analysis is likely invalid tomorrow. You do not want a ghost order lingering in the system for 3 weeks, only to get triggered when the market dynamics have completely changed. Set your pending orders to expire at the end of the trading day or week. This keeps your order book clean and relevant. Double-check your volume lot size. Does it match your risk calculation? Yes. Double-check your type. By limit? Yes. Double-check your coordinates. Stop loss is in place? Yes. Click place. You will hear a confirmation sound. On your chart, you will see green dashed lines appear. One for your entry, one for your stop, and one for your target. You have now deployed a trap. This brings us to the most powerful psychological hack in trading. Set and forget. Once that order is placed, your job is effectively done. You are no longer a trader. You are an observer. The urge will be to stare at the chart, willing the candles to move down to your entry line. You will watch every tick. This is toxic. It burns mental energy and leads to micromanagement. Imagine if a farmer planted seeds and then dug them up every hour to see if they were growing. The crops would die. Trading is identical. You have planted the seed, the pending order. Now you must let the market environment do the work. Case studies suggest that traders who use pending orders and walk away from the screen perform significantly better than those who sit and watch. Why? Because watching induces recency bias. You see 3 red candles in a row and you panic, deleting your buy limit because it looks like it's crashing. 5 minutes later, the price hits your now deleted level and rockets up exactly as you predicted. You missed the profit because you let fear override your analysis. In your demo account, I want you to practice this specific discipline. Place your pending orders in the morning and then close the platform. Do not open the app on your phone. Do not check the price at lunch. Come back in the evening or the next day to see the result. There are only 3 potential outcomes for your pending order. The miss. Price never reaches your entry level and flies away. You lost nothing. You made nothing. You delete the pending order. The loss. Price triggers your entry, you are in the trade, and then it hits your stop loss. You lost 1% of your demo account. The system worked perfectly. You paid a small fee for the opportunity. The win. Price triggers your entry, maybe dances around a bit, and then hits your take profit. You made 2% or 3%. There is a fourth, more nuanced outcome that involves active management, known as the break-even tactic. Suppose the price triggers your entry at 1.1200 and moves up to 1.1250. You are halfway to your target. You are in profit. To protect yourself, you can modify your order, right-click the order line, and move your stop loss from 1.1150 up to your entry price of 1.1200. Now you have a risk-free trade. If the market turns around and crashes, you get stopped out at 1.1200. You lose $0, minus a tiny bit for spread/commissions. This is a powerful psychological state because you have removed the fear of loss completely. You are playing with house money. However, be warned. Moving to break-even too early is a common rookie mistake. The market needs room to breathe. Prices rarely go in a straight line, they wiggle. If you choke the trade by moving your stop too close too soon, you will get tagged out on a minor pullback right before the price rockets to your target. We have successfully placed the order. The trap is set. The coordinates are locked. But now the silence sets in. The waiting game begins. And when that order finally triggers, when the dashed line turns into a live, fluctuating profit and loss number, a new set of demons awakens. You will see the numbers turn red. You will feel the urge to sell early to stop the pain. You will see the numbers turn green. You will feel the urge to take the profit immediately to bank the win before it disappears. This is the emotional grinder. In the next part, we are going to tackle trade management and psychology. We will discuss how to handle the trade in progress. I will teach you how to stay cool when the market is testing your resolve, and how to identify the valid technical reasons to exit a trade early versus the emotional panic that destroys portfolios. The plane is in the air. Now we have to land it. The moment your pending order transforms into a live trade, the atmosphere in the room changes. Even though this is a demo account, your brain struggles to distinguish between a simulation and reality. Neurochemically, the flashing red and blue numbers trigger the same dopamine and cortisol responses as if you were betting your mortgage. This is the live fire phase, and it is where the best analysts often become the worst traders. You have done the math, you have drawn the lines, but now you must manage the most volatile variable in the equation, yourself. Let's address the first phenomenon you will encounter: the drawdown. It is statistically improbable that you will enter a trade and it will immediately go into profit and stay there. In 90% of cases, the moment your order triggers, you will see red. This is partly due to the spread, the commission you pay to the broker, but mostly due to normal market breathing. The price will wiggle against you. It will test your entry level. It might even dance just a few pips away from your stop loss. Here is the imagine if scenario that ruins careers. Imagine you are in a long trade on the pound sterling to Japanese yen. You bought at 150.00 with a stop at 149.50. The price drops to 149.60. You are down 40 pips. You are staring at the negative number. Panic sets in. You think, I was wrong. The market is crashing. I need to save what's left. You manually close the trade to cut your losses. 10 minutes later, the price hits 149.55, just 5 pips from your original stop, and then rockets up to 151.00. You would have made a fortune. Instead, you took a loss because you couldn't handle the heat of the drawdown. This leads to a golden rule of trade management. Do not touch the stop loss unless the market structure has changed. Your stop loss was placed at a technical invalidation point. If the price hasn't hit it, your trade idea is still valid. The space between your entry and your stop loss is the cost of doing business. You must be comfortable letting the price explore that space. If you find yourself constantly staring at the negative number, you have likely risked too much leverage even on a demo. Reduce the size until you can sleep while the trade is open. Now let's look at the opposite problem, the profit anxiety. This is arguably more dangerous than the fear of loss. Imagine your trade goes into profit. You are up 20 pips. You see green numbers. Your brain releases dopamine, but then a red candle appears. The profit drops to 10 pips. You feel a sudden sense of loss. You think, I had 20 pips, now I only have 10. I better close it now before it goes to 0. You click close. You bank 10 pips. Then you watch in horror as the price continues to run for another 100 pips in your direction. You starved your winner. You ate the marshmallow immediately instead of waiting for the second one. To combat this, we implement a tactical maneuver known as the partial close, or scaling out. This is a feature in MetaTrader and most professional platforms that beginners rarely use because it requires a few extra clicks. Here is the step-by-step protocol for a partial close. Suppose you opened a trade with 1.00 lot. The price has moved halfway to your take-profit target. You are feeling anxious. Instead of closing the whole trade, you double-click on your active order line in the terminal. The order window pops up. In the volume field, you change the number from 1.00 to 0.50. Then you click the yellow button that says, Close. What have you just done? You have banked half of your profit. That money is now safe in your account balance. It cannot be taken away. But, and this is the magic, you still have 0.50 lots running in the market. You have satisfied your psychological need for security while keeping your exposure to the potential upside. This tactic transforms your mindset. You are no longer trading from a place of fear. You are trading from a position of power. You have already won. Now you are just seeing how much you will win. Once you have scaled out, you can apply the break-even stop strategy we mentioned briefly in the previous section. You move your stop loss to your entry price. Now, the worst-case scenario is that you make 0 on the remaining position, but you have already banked profit on the first half. You have created a risk-free event. This is how you compound wealth. You protect the downside aggressively and leave the upside uncapped. However, there are valid reasons to intervene manually. We do not advocate for blind trading. You must stay alert to black swan events or major news releases. If you are holding a trade and you see a breaking news alert that the central bank has just unexpectedly raised interest rates, the technical chart patterns might be rendered useless instantly. Fundamental shocks override technical structures. In such a case, it is professional to close the trade immediately to protect capital. Do not hope that the chart will hold up against a tsunami of fundamental data. Let's discuss the concept of the trailing stop. This is the tool for the lazy but smart trader. Instead of a fixed take-profit target, you can choose to trail your stop loss behind the price as it moves in your favor. If the price moves up 10 pips, your stop loss moves up 10 pips automatically. Imagine you catch a massive trend. The price keeps going up without hitting any resistance. If you had a fixed take profit, you would have exited at your target. But with a trailing stop, you stay in the trade as long as it keeps moving. You only get taken out when the trend finally reverses. This is how traders catch those legendary home run trades that make their year. On your demo account, experiment with this. Right-click your order, select Trailing Stop, and set it to 20 or 30 points, pips. Then walk away. Let the algorithm manage the exit. During this entire process, you must be performing one activity that no software can do for you: journaling your emotions. Open a notepad or a spreadsheet. Write down exactly what you are feeling while the trade is live. I am feeling sweaty because the price is stalling at resistance. I feel greedy because I want to double my position. Why write this down? Because patterns repeat. You will realize after 10 demo trades that you always get scared at 10 a.m., or you always get greedy after a loss. This data is more valuable than any indicator. You are debugging your own operating system. You will find that your biggest enemy is not the market. It is your inability to sit on your hands. Case studies of elite traders show they are often bored when trading. They have no emotional reaction to the fluctuating numbers because they have accepted the risk before they click the button. If you are feeling high highs and low lows, you are gambling. Your goal with this demo series is to reach a state of emotional neutrality. You want to be a casino manager, not a gambler. The manager doesn't care who wins the next hand of blackjack. They only care that the math guarantees the house wins at the end of the night. Eventually, the trade will end. The price will hit your stop loss, your take profit, or your trailing stop. The position will vanish from the active window and appear in the History tab. The adrenaline will fade. Most beginners immediately look for the next trade. They want the rush again. This is a mistake. The moment a trade closes is the beginning of the real work. The data is now static. It is a fossil record of your decision-making process. If you ignore this data, you are destined to repeat your mistakes forever. If you analyze it, you turn market tuition into an asset. You need to perform a forensic autopsy on every single trade, win or loss. Did you follow your plan? Did you exit early out of fear? Did you hold too long out of greed? Did the market respect your support level? Was your stop loss too tight? The answers to these questions are the bricks you will use to build your empire. In the final part of this masterclass, we are going to open that History tab. We are going to calculate the metrics that actually matter. Not just profit, but profit factor, win rate, and maximum drawdown. We are going to show you how to review your performance like a hedge fund manager, and how to transition from this demo environment to a live account without blowing up your savings. The flight is over, but the debriefing determines if you will ever fly again. The History tab is the only brutal truth teller in this entire industry. When you click that tab on your platform, you are not looking at a list of numbers, you are looking at a mirror. It reflects your discipline, your patience, and your emotional stability. Most beginners glance at the total profit number at the bottom right. If it is green, they think they are geniuses. If it is red, they think the market is rigged. This is a kindergarten level of analysis. To graduate from this masterclass, you must learn to export this data into a spreadsheet and perform a forensic audit of your own performance. The first metric you must calculate is not your win rate. This is the amateur's obsession. You can win 90% of your trades and still blow up your account if your losses are massive. Instead, you must calculate your profit factor. This is calculated by taking your gross profit, the sum of all winning trades, and dividing it by your gross loss, the sum of all losing trades. If the number is below 1.0, you are losing money. If it is 1.0, you are breaking even. The professional benchmark you are aiming for on your demo account is a profit factor of 1.5 or higher. This means for every dollar you lose, you are making $1.50. It proves that your edge is statistically significant and not just luck. Next, you need to look at your average win versus your average loss. This brings us back to the risk-to-reward ratio we discussed earlier. If your average win is $50, but your average loss is $100, you have a negative expectancy. You are swimming upstream. You need a win rate of over 66% just to break even. That is unsustainable. Your goal in the demo phase is to engineer a system where your average win is at least 2 times your average loss. If you achieve this, you can be wrong 60% of the time and still be profitable. Let that sink in. You can be a failure more often than a success and still make a living. That is the mathematical secret of the hedge funds. Now let's look at the maximum drawdown. This is the scary statistic. It measures the largest decline in your account balance from a peak to a trough. If you grew your demo account from $1,000 to $1,500, but then dropped back down to $800 before recovering, you experienced a massive drawdown. In the world of professional trading and funded accounts, a drawdown of more than 10% is often grounds for termination. It indicates reckless risk management or a strategy that collapses under certain market conditions. If your demo history shows a drawdown of 30 or 40%, you are not ready for live trading, even if you ended the month in profit. You survive by luck, and luck is not a strategy. We must also integrate the soft data, your emotional journal. Open your spreadsheet and add a column next to each trade in your history. Type in the emotion you recorded. Now sort the data. Look at your losing trades. Is there a pattern? Lost trade felt impatient. Lost trade revenge trading. Lost trade distracted by news. You will likely find that 80% of your losses are not due to the market doing something crazy, but due to you breaking your own rules. This is your leakage. Fixing these behavioral leaks is the fastest way to improve your P&L. You don't need a better indicator. You need better self-control. So, when are you ready to leave the simulator and fly the real jet? This is the most dangerous transition point. The imagine if scenario here is tragic. Imagine a trader who spends 3 months on a demo. They turn $1,000 into $5,000. They feel invincible. They deposit their life savings of $10,000 into a live account. In the first week, they lose $2,000. They panic. They have never felt the physical sensation of losing real money. Their heart races. They start making irrational decisions to win it back. Within a month, the $10,000 is gone. To avoid this fate, you must follow the bridge protocol. You do not jump from demo to a full-size live account. You step onto a micro or cent account. These are live accounts where you deposit a very small amount of money, perhaps $50 or $100. The lot sizes are microscopic. You might be trading for pennies. Why do this? Because even though the money is small, it is real. When you lose 50 cents, it triggers a different part of your brain than losing 50,000 virtual dollars. You need to acclimate your nervous system to the sensation of risk. You need to prove to yourself that you can execute your strategy flawlessly when there are real consequences, however small. If you cannot be profitable with a $100 account, you certainly cannot be profitable with a $10,000 account. The market does not care about the size of your balance. It treats all capital with the same ruthlessness. Case studies of successful independent traders suggest a timeline that looks like this. Phase 1. Demo trading for 3 to 6 months. Goal: consistency, mechanical fluency, and a profit factor above 1.5 over at least 100 trades. Phase 2. Micro/cent account for 3 to 6 months. Goal: emotional regulation, sticking to the plan with real risk, maintaining the profit factor. Phase 3. Scaling up, gradually adding capital as you prove your consistency. This is not a race. The market will be here in 10 years. The only question is whether you will be. The rush to get rich is the primary cause of poverty in the trading world. By treating this as a multi-year apprenticeship rather than a weekend hustle, you place yourself in the top 1% of aspirants. You have now completed the entire circuit. We started with the harsh reality of the 90/90/90 rule. We built your workstation. We decoded the candlesticks and mapped the support and resistance zones. We identified the trend and timed the entry with indicators. We calculated the risk to the penny. We set the trap with pending orders. We managed the psychology of the live trade. And now we have audited the results. You possess the blueprint. However, a blueprint does not build a house. You have to lay the bricks. Every single day you open that chart, you are laying a brick. Some days the brick will crack. Some days the weather will be terrible. But if you show up, follow the protocol, and respect the risk, you are building a structure that can provide financial independence for the rest of your life. Trading is the hardest way to make easy money. It requires you to master the most difficult opponent you will ever face, yourself. The charts are just a mirror reflecting your own psychology back at you. If you are greedy, the market will bankrupt you. If you are fearful, the market will freeze you. But if you are disciplined, patient, and humble, the market will pay you. This masterclass has given you the tools, but the craft is in your hands. Do not deposit real money until you have proven you can handle the demo. Do not increase your size until you have earned the right. Respect the process. Trust the data. And remember, in the game of Forex, survival is the only grail. If you can survive long enough to learn the lessons, the profits are inevitable. The journey of 1,000 trades begins with a single, well-executed, risk-managed click on a demo account. You are now cleared for takeoff. Good luck.